Okay, I think we're live now, so we'll give people a minute to sign on and adjust your volume. It's kind of an ugly day in the markets today, so I think we'll get started. So my name is Matthew Cruz. I'm here with Lori Carter. She's our branch office manager out of Garden City, Kansas, and so she's going to be presenting her grain and cattle marketing strategy for 2022. And if as we go on, if anybody has any questions, feel free to type them in at the Q&A box. There is at the bottom part of your screen, there should be a box that you can click on that says Q&A, and we might not get to those questions till the end, but feel free to type those in because I know it can take a little while for those to think and type up those questions. So without further ado, Lori, I'll hand it over to you.
Hello, I'm Lori Carter. I'm, like as Matthew said, branch manager and broker in Garden City, Kansas. My input and ideas that I have today focuses pretty much on grains and cattle because that's what most customers are interested in my area here in Southwest Kansas. Starting out, there's a disclaimer. You can read that at your leisure. And then the first slide I have here is market perspective, current underlying issues. And we'll just discuss those a little bit, or I will. I do talk fast. It's a habit. I apologize. If there's questions or misunderstanding, I think you can look or listen later. The first thing I'm going to mention would be inflationary pressures. We're all aware of those. We hear it on the news every time we listen, and it's in our face every time we pay a bill or go to the gas pump. Some of that, I believe, has probably been exaggerated somewhat by commodity fund buying in basically all commodity futures. The next thing, high input costs. Any of you who are a producer are certainly aware of those. One in particular would be fertilizer, and I've seen commentary blaming that high fertilizer, especially anhydrous, on high natural gas costs. And this is just a point for perspective. Natural gas is not cheap, but it is 23% below the high that it put in last October, just for reference. The most recent development over the weekend, I heard that customers got letters from Bayer where that company was claiming force majeure on glyphosate. They have a manufacturing issue in some of their inputs, so maybe not able to meet some commitments. The next thing, weather concerns. Brazil and South America have been at the forefront of those concerns, mainly over drought conditions, which we all know has tightened the size of the soybean crop there in particular. Most recent developments have seen some moisture coming in that may be holding harvest up a little bit of soybeans, but also on the other hand, seems to be particularly beneficial for planting of safrinha corn. Potential weather impacts in the U.S. Everybody here knows that we've been dealing with mostly drought-like conditions. We hope that that doesn't continue. I did listen to a weather outlook from a meteorologist that Commstock gets information from. A lot of questions had been raised to him about comparing this year to 2012. And I'm no meteorologist, but from what I got out of his information, there are some things going on in the global weather, all the things that impact it out in the oceans that are not like 2012, just for reference. Next issue, the conflict between Russia and Ukraine. Everyone's aware of that too. If you've watched markets at all, you've probably seen the market impact. From one day to the next, we have rumors about furthering trouble, and then like overnight, last night, maybe some calming down of that situation. That has affected particularly the energy markets in a big way. And because of some other things that will probably come up in discussion, that does spill into the grain. It makes sense because corn's used for ethanol and soybeans are used for biofuel. And those have all the prices of those have been supported by the prices in the grain, in the energy. We've also probably heard constantly on the news that stocks of energies overall are fairly low. However, recently we have seen stocks building in gasoline, ethanol, and aviation fuel. Next thing, outside market influence, black swan, white swan events. If you go looking for a definition, I call it what happened with COVID a black swan. Some things I read said it shouldn't have been because a virus like that should have been predictable. I guess I don't know anyone who could have predicted all the effects on all of us and all the markets that we deal with. Economic disruption, again, kind of goes into what we discussed with Russia and Ukraine, and even the influence of the energy markets on most all the other markets that we deal with. So with all that being said, I feel like the price levels we're at on grains right now, I'm not saying they aren't going higher, but I think that they provide some opportunity for hedging or risk management. And the strategies we're going to look at are kind of using options to do that in a way that we could still benefit from higher prices potentially. So the first thing I have to show is a monthly Kansas City wheat chart. That's because out here, hard red winter wheat is what we deal with all the time. The market here, if you look at a long-term chart, you can see that it's probably high for the last 8 to 10 years, not as high that it's ever been, but definitely has seen the rubber band effect of prices going too low over COVID issues, and then the rebound to high prices, maybe higher than they should be. That remains to be seen. If you look here, probably the market around 830 on this chart. Point I'd like to make, you can see wheat at 1320 back in 2008. Just for reference, Kansas City wheat at harvest time that year was 844 on the futures. So the first strategy I have would be to try to protect some new crop Kansas City wheat with an option spread. Well, actually selling the wheat and then reopening with a bull call spread, selling the futures between $8 and $8.20. When I set this slide up, the price closed that day at 833. A little bit before I started this program, the market was at 814. So even with the gyrations back and forth, we're still in that same price range. You could reopen the upside with a bull call spread, buying a July 820 call at about 58 cents, selling a July $9 call at 36 cents to help retrieve some of that cost, a net cost of 22 cents. A third side to that, an optional side with more risk, downside risk, selling a July $7 put at about 16 and a half. Net cost would be about 6 cents there for the total transaction. Comment there that you could use September because July futures go off the end of June and sometimes don't provide enough time to protect all the way through harvest. This strategy, the second strategy, would be a put call window or fence where you're just locking in a floor and then with a put, buying a 810 put, selling a $9 call at a net cost of 27 cents. Here I did use the September, so that would cover through harvest time. Something I want to comment just to call attention to it. It's not very often I think that we see opportunities to make a multi-year sale at a price this close to where we're currently trading. July Kansas City wheat, when I wrote this slide, had a double top at $8. It did make a new high, I think, night before last at 805 3/4. Again, to point out, like I did when we looked at the Kansas City wheat chart, the highest I could ever find, the price of Kansas City wheat at harvest on the board was 844. Rarely are you able to lock in a price a year out that close to the highest you've ever been able to sell at harvest. Options are thin that far out, but I did find that you could buy a 780 put and sell an 880 call for a net cost of about 37 cents, which would put you at a floor above 750. So again, options thin out there. It might take a little work to get that done, but that looks attractive to me. Next thing is a monthly corn chart. Kind of the same thing as the wheat. I would say not as high historically as the wheat, or not currently. We did get to 750 last year, so that would have put us up in the upper end of the range. Again, I feel like new crop corn prices could eventually fairly easily go to 638 on December. We did do that last year on the December contract. I think that's a target. I don't know that that's a guarantee with everything that's going on. It probably would happen if we have weather issues this spring and summer. Here's a monthly corn chart just for reference. And an old crop corn strategy here. First one, strategy one, delay pricing the corn. If you still have some old crop corn left around here, I'd say we have some left. I'd say we also have had quite a bit of it sold because we have had an exceptional basis. Farmers here getting 94 to $1 over the March board on old crop corn at feed yards in the area. So if you were to hold the corn, you could buy a 620 put, sell a 670 call for about 11 cents to protect at least part of the downside. Strategy two, sell the cash corn and replace the corn with options, buying a 630 corn call, selling a 730 corn call at a net cost of 29. Could also be used as a courage call to price grain later on if you had this option position in place. New crop corn, an attractive looking strategy for me. If you sold the futures around $5.80 to $6, reopening the upside with a bull call spread so you could still participate in a higher moving market, buying a 580 call, selling a 650 call at a net cost of 22 cents. That additional third leg, you could add selling a put to bring the net cost down to 5 cents. Again, downside risk to that strategy. Strategy two, the fence or the window, buying a December 580 put, selling a December 680 call at a net of 27 cents. This strategy looks attractive. Worst case scenario, selling corn at 652 if the market moves higher. I'm going to go back a little bit because I have the soybean chart here, a little bit in the wrong order. Again, relatively high prices. You can see not at the highest ever, but not too far off of those. And so then we'll look at some strategies on soybeans, which are not a big crop in our area. But I still do some hedging business, and a few people like to speculate that market moves more than most anything else. So first strategy there, selling new crop beans, selling the November futures between 1440 to 1480. When I put this together yesterday, we were at 1441. Probably a little lower than that as we're speaking based on what the market was doing this morning. If you sold the futures there and reopened the upside with a bull call spread, buying a November 1460 call, selling a 1560 call at a net cost of 31. So for 31 cents, that would give you $1 open on the upside. Strategy two, similar to what we did before on the corn and the wheat, protecting the downside with a put call window or a fence, buying a 1440 put, selling a 1540 call at a net cost of around 30 cents. Or sell, if you wanted to give yourself more upside room, selling the 1640 call for a net cost of 55. Okay, that's it for me on the grain. On the cattle market perspectives, I got some other commentary. Cattle on feed numbers are near a cyclical peak. They are higher than last year at the moment, but that should be sliding from here on out. Retailers having backed off the highest prices at the grocery counter should help with demand for beef. Slaughter levels are slowly ramping back up after an Omicron-related slowdown that kind of kept them from harvesting the numbers that we would have liked to see. On the other side of that, carcass weights are only a pound off the record due to those previous slowdowns and what I hear from guys, record performance in the feed yards because of a fairly open winter. That combination of gradual supply decline and seasonal demand improvement should be supportive to the market from here on out. However, I noticed that premiums in both the live and feeder cattle markets offer opportunities for price protection. If you look at a monthly live cattle chart here, you can see where we are at compared to historical levels as well. 170 being the high that happened. That's possible at some point in the fat cattle market. If the economy continues to move forward and without any of these outside events, it is possible. I'm not sure that it's likely, but it is something that could happen. On the feeder cattle, again, we're not as high, we're not at the highest levels we've been, and yet we are fairly high in the historical perspective. I did want to call attention to the fact that the back months of feeder cattle, I'm going to use the August as an example, are at a very large premium to the front, and therefore providing some, I think, opportunities to protect risk as well. On this chart, you see August feeder cattle, about 184.91. Before I started this program, we had made a new contract high in the 186 level. So the strategy that I'm going to present here could be done even better than what I show. So again, we're looking at a fence or a window. I like these strategies because they get downside protection and leave you some upside room. Again, buying April live cattle 146 put at about 282, selling the April live cattle 162 call at 90 for a net cost of $1.90. That gives pretty good protection to the downside with the 144 floor and leave you room up to about 160. Again, you could do a third leg of that to help pay for it some more by selling a 140 call for about $1. On the feeder cattle, similar strategy, buy August 184 feeder cattle put at 722, selling a 194 call at 382 for a net cost of 340. That would lock you in a floor of about 180 and leave you some room on the top side. Again, this strategy could be done quite a bit better because the market has since then made new highs. I just want to mention spec trade ideas because we're always open to help if somebody's interested in that. We have a subscription to More Research, which presents seasonal trades every month that have worked at least 12 out of the last 15 years. Doesn't mean that they will, but it gives ideas of what normal seasonal patterns for lots of different commodities. I also like to mention things that appear to me historically too cheap, natural gas being one of them, platinum being the other. Both those markets are well off the lows they made in 20 off of COVID, and yet in relation to other markets, are still relatively low. Platinum only 7-8 years ago traded at a premium to gold and palladium and is far below the price of either of them at this point. Natural gas, like I said, isn't cheap, but it is at 20-30% off of the 2014 highs it tested back in October. Commodities that appear too high, in my opinion, crude oil and unleaded gasoline. Again, stocks are fairly tight, but the price is reflecting that as well. Contact information, because that's about all I have. You can call me at the office phone 712-227-1171 or the toll-free number 800-242-5014. My cell phone 620-287-4018.
Well, one question we have is being in Southwest Kansas. Do you see an increased need for corn in that region with an elevated number of cattle on commercial feed?
Always. Yes, that's why the 94 to a dollar basis in our area paid by feed yards. Is that what the question asked? If we see a continued?
Yeah. Do you see an increased need for corn in that region with an
Yes.
elevated number of cattle on commercial feed?
Yes, for sure. Though that number is, as was discussed earlier, set to drop off some with peak numbers on feed at the moment.
Mm-hmm.
But we also have dairies and hogs around too, and an ethanol plant. So
Yeah.
yes, I mean, I feel like we in this area are bigger users than producers of corn.
A lot of the focus is going to talk more about the acre wars here pretty soon, or probably has already started. We talked about that a little bit in our report this morning, that how there might be some corn acres stolen to sorghum or some other small grains. Do you see $8 wheat rob some of those acres?
I do. I think that normally in our area, there some people actually plant wheat to hold the ground or to graze. And I think that both of those things won't happen as much with $8 wheat as they would if it was $5. In other words, if they plant wheat to hold the ground, they kill it out and plant something else behind it in the spring, like corn or milo. Milo more likely because it's a dry land crop as well. I don't think that'll happen as much. So that to me would be supportive to new crop corn.
Okay. All right. Yeah, if anybody has any other questions, feel free to type those in. Maybe give them another minute, see if we get some more questions. So with the talk a little bit, Lori, about the energy correction that we're seeing today. We're down over $3. We're down almost $4 at one point in the crude. But everything you read talks about how, we're going to go to $100, and if Russia invades Ukraine, you go to 150. And so even without Russia invading Ukraine, you're going to go to $100. Do you agree with that?
I guess I feel like we might, if we sell the market off from this level, significantly prior to that happening. But that's my opinion.
Yeah. Okay.
We've not had a correction in a long time, of any size at all. There will be the first of two energy reports today that'll tell us what stocks are doing. Like I said, they have been building of some of the products, the gasoline. If you look at aviation fuel, like up 40%. And that all makes sense because we know there's been flights canceled for the last couple of months in a big way, and that's hard to get back.
Yeah.
I'm not saying it's going to $30, but if natural gas can make the kind of correction it did, and it's actually at the moment in storage 9.2% below 5-year average, then I can't naively think that the crude oil couldn't have a significant correction.
Yeah. Well, I mean, as you pointed out, it's down, what'd you say, 23% from last October, right?
Right. It's actually corrected about 46%, but it's come back off that bottom part of the way. So that's the current price.
Yeah, and it's had that huge spike a couple of weeks ago, but we're at least where we're at. It seems like we've had a fairly mild winter. We haven't had much snow. We had one big snow, but I don't know. I would think that would probably weigh on the market a little bit, just the lack of extreme cold. I mean, obviously we have some cold days, but it's didn't last very long so far. But I guess the winter's not over yet either.
Yeah, and I think that's true. But part of that is on the storage report. So even though we haven't we're still 17% under last year and 9% below a 5-year average. So that's without having any dramatic winter storms. So I guess that actually is part of the point.
Yeah. Well,
My
I'll put you on the spot here. So, you know, a lot of people are going to want to know, well, is the high end now in the grains? Because we spiked up last week and now we're having a down day. And so do you think it's over, or is the market just going through another correction and kind of rebuilding momentum?
Well, and it's, I mean, I have to talk like a politician a little bit on this one, I guess. If you put me on the spot, I believe it could be. I feel like chart indications last week showed some topping action, particularly in the soybeans, old crop soybeans. And really that was prevented, I believe, from follow through by all the concerns over Russia and Ukraine. You could see it momentarily in the market the minute a rumor came out.
Mm-hmm.
So I feel like the chart action, they didn't completely negate it, but it was calmed down, or it that prevented it from having follow through to the downside to confirm a top. That makes sense?
Yeah. Okay. So you think that it could be in, is what you're saying?
I do.
Okay.
But I'm not trying to predict what happens in Russia and Ukraine.
Yeah.
But without further escalation and problems there, I would say yes.
Yeah. Okay. Well, any other, maybe one final question. Talk a little bit about basis in your region, and what's it doing? What do you see it doing?
It's been strong again because of all the eaters we have, especially on corn. Milo too, though nothing like it was maybe a year ago when it was extremely carried away. I did notice that I meant to mention this earlier, but might have missed it, that export inspections on grain total overall are 20% behind where they were at the same time last year. I know that it's only mid-February. But that's a reality. I think the one thing that wasn't very far behind or was keeping up was actually sorghum. So there obviously is still demand for that. I guess I think, I don't know that we're going to be able to maintain the basics levels that we've had just here recently. I would probably expect them to slip somewhat.
Mm-hmm. Okay.
But that's going with my idea that maybe we've peaked out on that for now.
Yeah. Okay. Well, looks like we're out of questions. Laura, do you have any other final comments?
I don't think so.
All right. Well, thank you everyone for joining us. If you have any interest or any about trading ideas, give Lori a call. The office number is 712-227-1110. Thank you, everyone. Have a good day.
Thank you.